I heard of an interesting African proverb which says, "Don't test the depth of the river with both feet." In other words, one should manage their risks appropriately. Hi, my name is Jimmy Walaviechi, and you're welcome to Corporate Governance Africa, where we seek to promote good governance through field. In this video, we consider the critical issue of risk management. We explore the measures that a board, owner of a business, or a management team could consider applying to ensure appropriate risk management in their organizations at all times. We consider the example of Silicon Valley Bank, once one of America's largest banks. It collapsed in 2023, largely due to weak risk management practices. Risk management is the systematic process of identifying, assessing, and mitigating threats or uncertainties that can impact your organization. It involves analyzing the likelihood of potential impact of risks, developing strategies to minimize the harm, and continually monitoring the effectiveness of these measures. In this video, we will explore the weaknesses of SVB's or Silicon Valley Bank's risk management practices and draw valuable lessons from this unfortunate turn of events. In exploring the example of the Silicon Valley Bank, I shall refer to the findings of a review of the Federal Reserve System following the collapse of the bank. The review was carried out to find out the causes of the collapse of the bank. The review was carried out under the auspices of the Board of Governors of the Federal Reserve System of the United States of America. The report is dated the 28th of April 2023. The Federal Reserve System functions as the central bank of the United States of America. Silicon Valley Bank was founded in 1983 with a vision to provide specialized financial services for startup companies in the tech industry. Over the years, SVB expanded its services and customer base, establishing itself as a central provider of financial services to the tech industry, including venture capitalists and technology startups. Between 2019 and 2022, SVB experienced a period of significant growth as the bank's assets tripled. The reason was because of increased deposits from startups and tech companies. The big deposits were because the startups and tech companies were experiencing a time of growth in their businesses. The reason for this growth was because of large capital inflows from investors into the tech companies. It was a period of low interest rates and cheap credit. There was also an increased demand for technology solutions during the COVID-19 pandemic. With more deposits from these startups and tech companies, SVB had more capital at its disposal for investment. But what did SVB decide to do with this increased capital? SVB's management invested a significant portion of its assets on government bonds. These investments are generally considered to be safe since they are backed by the government or government-sponsored entities. However, these bonds come with a serious risk called the interest rate risk, which SVB did not manage well. In order to understand the risk that SVB faced with these government bonds, it's important to understand what these bonds are and how that risk arises. A bond is essentially a loan that investors provide to governments or to companies. In return, the government or the company pays regular interest and repays the principal amount after a set period of time or the maturity date. SVB invested heavily in long-term government bonds, expecting a stable return over time. Bonds can be bought and sold on a market, just like shares can be bought and sold on the stock market. However, bonds carry a particular risk related to interest rates. When interest rates rise, the value of existing bonds with lower rates on the market falls. The reason is because when interest rates rise, then these newer bonds which are issued in relation to these higher rates of interest are more attractive to investors. The reason why these bonds with a higher rate of interest are attractive to investors is because they attract a higher rate of returns to the investors compared to these other bonds which were issued with lower interest rates. just like the Silicon Valley Bank's bonds. This interest rate risk may further be explained by the analogy of bananas in a typical African grocery market. Imagine a small grocery store owner in a tropical African town who typically sells a variety of local produce like cassava, bananas, maize, and tomatoes, each outsourced from different farmers. This strategy helps the owner manage risk because if the crop has a poor harvest or less demand, the others can still sell well and keep the business running smoothly. One season, convinced that the bananas are going to be on high demand due to a regional festival, the store owner decides to use all of their money to buy only bananas, thinking that his profits will be maximized. They stop buying maize, they stop buying cassava, they stop buying tomatoes, believing that the festival will guarantee a big payday. But just after stocking up, a neighboring region, a neighboring district or neighboring town floods the market with cheaper bananas, and many customers are now opting to buy cheaper ones elsewhere. The grocery store owner is left with a large stock of bananas that are rapidly ripening and they are losing value. What does he do? They are forced to sell the bananas at a lower price just to avoid complete loss. But it's not to cover the costs that they spent initially. If the owner had continued to stock a variety of produce, they wouldn't have been in such a risky or dire situation in their business. This is what happened to Silicon Valley Bank when the Federal Reserve Bank increased interest rates in March of 2023. SVB had risked it all by investing heavily in government bonds without diversifying. When the interest rates rose, the value of their bonds dropped and they were left struggling, just like that store owner with their bananas, with their too many bananas. In both these cases, not spreading risks led to significant financial loss. At about the time the interest rates were raised, the tech sector experienced a downturn. The companies which had previously deposited large sums of money with Silicon Valley Bank began to withdraw their money. They withdrew their money in order to meet expenses like wages and overhead costs of their businesses. SVB was forced to sell the government bonds at a loss in order to meet the withdrawal demands of its customers. When customers realized that SVB was selling its bonds at a loss, there was a bank run as the customers knew that SVB was in serious financial trouble. As a result of this state of affairs, SVB could no longer meet its financial obligations. What happened after that? On the 10th of March 2023, the Federal Deposit Insurance Corporation, FDIC, took control of SVB. The inability of the bank to pay the depositors was a manifestation of another risk called the liquidity risk. The bank failed to address the interest rate risk and the liquidity risk. Weaknesses in its risk management were identified as a key reason for its collapse. There are a couple of lessons related to risk management that any business owner or manager or board of directors could learn from the unfortunate experience of Silicon Valley Bank. It is important for boards to ensure that there are competent officers who are dedicated to risk management in their organization. In April 2022, SVB's chief risk officer left the bank. The chief executive officer failed to find a replacement until December of 2022. During the period when there was no chief risk officer, a committee of senior risk officers managed the risk oversight. However, a report by the Federal Reserve System found that this measure was not sufficient to manage the risks effectively. This shows that boards should ensure that organizations have adequate succession planning for crucial positions like that of the chief risk officer. The reason for the succession plan would be in order to ensure that such officers are quickly replaced. Boards or owners of organizations should ensure that there are adequate risk structures and frameworks in place in order to identify and address risks. The report of the Federal Reserve System found that SVB's risk management structure was not adequate. It lacked a fully integrated approach. An integrated approach means that all parts of the organization work together as a team to manage the risks. Instead of each department handling the risks on its own, they share information and strategies, ensuring that nothing falls through the cracks. In this way, the risks are tackled more effectively because everyone in the organization is on the same page where the risks are concerned. The absence of a good risk framework and the lack of an integrated approach hampered the bank's ability to recognize and respond to emerging risks. By way of example, SVB's management did not respond appropriately to repeated warnings that the Federal Reserve Bank of the United States would increase the interest rates. There were already indications that there would be an interest rate hike in order to curb inflation. Instead, the bank continued to invest heavily in government bonds when interest rates were near zero. They did not properly assess the risks associated with a potential interest rate hike. It's important for boards to ensure that their organizations have a robust internal audit structure. The Federal Reserve's review found that SVB's internal audit department did not adequately challenge management or provide timely reports to the audit committee. This gap hindered the bank's ability to ensure effective risk management, governance, and internal controls in the organization. The internal audit function is like an internal watchdog for the organization. The internal audit function helps an organization to address risks like those faced by SVB by keeping a close eye on how the organization is managing its risks. The board composition of Silicon Valley Bank was also problematic. At the time of its collapse, SVB's board comprised 11 members across 7 committees. The board committees included the Audit, Technology, Finance, Governance, Credit and Compensation committees. However, there was a lack of experience in risk management among the board members. The Federal Reserve's report noted that the board lacked large bank experience. This large bank experience was crucial for understanding the complexities of risk management of an institution of the size of SVB. And this lack of expertise contributed to the board's failure to establish appropriate risk management practices and to hold the management accountable. Thus, the board composition should include directors with expertise in risk management, and that expertise should be appropriate to the size of the organization. The report of the Federal Reserve System found that the full board did not receive adequate information about SVB's risks from the management. For example, information updates that management sent to the board did not appropriately highlight SVB's liquidity challenges until November 2022. This was despite the fact that conditions at the bank as it relates to risk management were getting worse, they were deteriorating. It's important for boards to establish the right information infrastructure so that they can receive relevant, important information from the management in a timely manner. Ram Charan, a leading governance expert, defines information infrastructure as ways in which the board gets information about its organization. The different aspects of information infrastructure include board briefings, management letters, employee surveys, board committee reports, and director outreach. Ultimately, where information infrastructure is concerned, boards ought to test their information infrastructure against its ability to provide the right information in the right format and at the right time. This applies even to information regarding risk management. The board also did not hold the management properly accountable for risk management. This was shown from the compensation packages which were given to the managers by the board. The Federal Reserve found that compensation packages of senior management all the way through 2022 were tied to short-term earnings or short-term profits and equity returns and did not include aspects related to risk management. The result was that the managers had a financial incentive to focus only on short-term profit instead of ensuring that there is sound risk management in the organization. Considering the vital importance of risk management, it's important for boards to ensure that there is a compensation package that includes a risk management component. And this is important so that the management does not prioritize short-term profits over sound risk management practices of their organization. A failure to give effective oversight over risk management may expose board members to liability. On the 18th of December 2024, the board of the Federal Deposit Insurance Corporation voted unanimously to approve the staff's request for the authorization to file a suit against 6 former officers and 11 former directors of Silicon Valley Bank. Among other reasons, the board considered that even as the interest rates were raised by the Federal Reserve Bank, the management removed the hedges that could have shielded or mitigated the banks against the interest rate hikes. The threat of liability means that board members ought to exercise the appropriate duty of care, skill, and diligence in giving oversight of risk management of their respective organizations. This is important not only to promote the success of the organization, but also to safeguard themselves against potential liability. It's important for any business or any organization to continuously assess how they manage risks specific to their industry. This involves having competent people to manage the risks, both at the board level and at the management level. They should also establish the right risk management structures. When boards or owners of organizations ensure that there is appropriate risk management in their organizations, they ensure the sustainable growth and survival of their organization, and they would avoid the challenges that SVB faced. Effective risk management is not just about compliance, it's about ensuring the long-term survival and success of any business. How else do you think an organization can improve their risk management strategies? What else can your organization learn from the collapse of the Silicon Valley Bank?